Are buyers roaring back into the Sydney property market, or has it simply stabilised? Let's look at the most recent data to get an idea of what's been happening and what might happen until the end of the year. So the most recent development, or the most recent major development, was the RBA cut rates by 25 basis points in October. It's brought the official cash rate down to 75 basis points, which is one of the lowest on record. Now, while the banks haven't passed on the full extent of the rate cut, they have passed on the majority of it, making debt relatively cheap for borrowers. This reduces the cost of existing debt and of course reduces the cost of future debt when buyers go out to borrow for another property. That would provide some stimulus into the market. So let's see what's actually been happening. Now, we haven't had that many weekends since the rate cut occurred. One of the weekends after the rate cut was simply a public holiday weekend. The data from such weekends is very patchy, there's few properties coming to market, it's not that reliable. And we've had one other full weekend after the rate cut, which has been relatively healthy. However, it's largely reflected what's happened in September and in August. So let's look at what's been happening. Now, basically the clearance rates have been relatively stable for the past few months. It's been about mid-70s. Sometimes it's been in the low 70s, sometimes in the high 70s. It's hovered around the mid-70s nevertheless for the past few months, suggesting there's some confidence on the part of buyers when actually going out to purchase properties, at least if it's at the right price. Also, vendors appear to be willing to accept some of these prices. This suggests vendors might have become more realistic about the prices their properties might fetch. So that's the first piece of positive information. The second piece of positive information is the number of properties coming to auction. Now, it's not quite the same as at the boom time, but it still is much higher than it was previously, suggesting vendors are more confident bringing their properties to market and/or that vendors are more realistic about the price their property might ultimately get. Now, these clearance rates and also the properties coming to auction can be a little bit misleading, because many properties can be withdrawn prior to auction if vendors aren't confident about making a sale or if they simply don't think they'll get the price that they want. Nevertheless, more properties are coming to market, which is a positive signal. Now, it's important to bear in mind that during spring, typically there are more properties than during winter, but nevertheless the increase is generally confidence inspiring. However, there are some factors that slightly offset this. The major offsetting factor is that prices have been stagnant. Now, if you were expecting buyers to be roaring back into the market, you would expect an uptick in prices. Now, if we look at the median price for properties that are sold, it's about 1.1 million to 1.2 million, depending on which weekend we're looking at. It's fluctuated between that band basically for the past year. What this suggests is that while clearance rates and while the number of properties have slightly increased, this doesn't translate into higher prices. This suggests that buyers are willing to come back into the market, but only at the right price, and vendors appear to have attenuated what they're expecting from a sale, suggesting a bit of a meeting of buyers and sellers in order to facilitate a sale actually going through. Put differently, while there's an increase in interest in the market and increased willingness to buy and to sell, that's really resulted in property prices kind of being pared back a little bit and more realism about what properties will actually sell for. So what this suggests is the market is relatively healthy at the moment, buyers and sellers are relatively confident, but prices are unlikely to shoot upwards because buyers and sellers seem to have reached an equilibrium rate at which they're willing to transact. So what does that mean going forward until the end of the year? Well, what it suggests is probably we'll get more of the same going through until the end of the year. Unless we get a significant rate cut that provides significant stimulus and therefore increases purchases to a large extent, one wouldn't really expect that much of a change. And additionally, if there is a significant rate cut, that might actually be a negative signal about the economy. Because if we've got a negative signal about the economy, that would suggest sluggish wage growth or sluggish employment, which would to some extent reduce the ability to actually go out and buy properties. So that's likely what we'd expect going through until the end of the year. Now, it's important to bear in mind some other stimulatory factors are at play here. We obviously have the interest rate cut, and we also have the changes that APRA had to its serviceability requirements for going out and getting debt, which of course has manifested in at least a stabilization of these interest rates, a stabilization rather of the interest in property, and a stabilization of the buyer's willingness to go out and buy. So I hope this has given you some idea about what's happening in the Sydney property market, about the idea that while there is a stabilization and a general positive mood about the property market, it's not likely to see a significant uptick or a significant surge in prices, and buyers don't appear to be roaring back so much as willing to re-enter the market at an appropriate price. So I hope this has given you a bit of an update about what's happening in the property market. I hope the video has been interesting to you. If it has, it would be great if you click the like and subscribe buttons, and I hope to see you next time. Bye.